Ethos Ltd reported strong Q2 performance. Revenue surged 26.4% year-on-year to 297 crore rupees, beating the estimate of 285 crore rupees. EBITDA rose 12.8% to 42 crore rupees, slightly missing the expected 48 crore rupees. The EBITDA margin compressed to 14.2% from 15.9% last year, also falling short of the projected 17%. Net profit increased by 14% to 21.2 crore rupees, lagging behind the expected 26 crore rupees. While top-line growth remains impressive, profit margins are under some pressure. Overall, the revenue beat highlights robust demand, but profitability challenges are worth watching. Ethos Ltd is a prominent player in India's luxury watch retail segment, with a market capitalization of 7,003 crore rupees, categorizing it as a small-cap company. It operates in a niche luxury market, relatively insulated from inflationary concerns as it targets high-net-worth individuals, who remain less affected by economic fluctuations. Ethos leverages this resilient consumer base, benefiting from rising aspirations and the growing trend toward premium purchases. As India's largest luxury watch retailer, Ethos commands a 13% share in the premium watch retail market, capitalizing on exclusivity and brand strength. Valuation metrics for Ethos Ltd reveal a stretched picture. The stock is trading at a price-to-earnings (PE) ratio of 79.6, significantly above its historical median of 71.2. This elevated valuation reflects high investor expectations for sustained growth. However, with the PE being much higher than peers and the broader market, investors must assess whether the premium is justified given current profitability metrics. The rich valuation emphasizes the importance of continuous performance improvements and growth prospects. The high PE ratio poses a risk if future earnings disappoint. Ethos Ltd has showcased impressive growth over the last 5 years. Sales have compounded at an annual growth rate of 18%, with a robust recent trend, clocking 37% growth over the last 3 years. Profit growth has been even more striking, with a 5-year compound annual growth rate, CAGR, of 44% and an astounding 160% over the past 3 years. This indicates exceptional performance, albeit from a lower base. However, maintaining consistency remains crucial as fluctuating profit margins could influence future growth trajectories. Stability and execution will be key focus areas. From a technical perspective, Ethos Ltd is trading at 2,860 rupees, down about 18.9% from its 52-week high of 3,525 rupees. The stock appears to be holding its long-term trendline support, which has provided a solid base since early 2023. This level is crucial for future bullish momentum. The upward trend remains intact, suggesting that investors may see this dip as a buying opportunity if the trendline holds. Watch for signs of sustained support at current levels, as a break below could signal further downside risks in the short term. Tata Motors' latest quarterly performance presented mixed results. Revenue stood at 1.01 lakh rupees crore, missing the expected 1.03 lakh rupees crore by 3.5%. EBITDA came in at 11,736 crore rupees, significantly lower than the expected 14,636 crore rupees, with margins compressing to 11.6% from the anticipated 14%. Net profit was 3,450 crore rupees, down 10% year-on-year, and also under the projected 4,805 crore rupees. The results reflect ongoing challenges, particularly in profitability, despite robust top-line figures. Lower margins and earnings indicate cost pressures or inefficiencies, key areas of concern for investors. Tata Motors is a behemoth in the global automotive space, with a market capitalization of 2,96,578 crore rupees. It has witnessed a remarkable turnaround in recent years, thanks to the successful launch of new vehicle variants that have resonated well with consumers. The company's efforts in the electric vehicle (EV) space have further fueled its growth. Additionally, Tata Motors holds shares in Tata Technologies, which has provided some cushion to its stock price. The strategic asset and improved performance have made the company more attractive to investors, even in a competitive environment. Currently, Tata Motors trades at a P/E ratio of 8.7, which is notably lower than its historical average. This subdued valuation indicates that the market is pricing in expectations of tepid profit growth in the coming quarters. While this may suggest an attractive entry point for long-term investors, it also reflects cautious sentiment given the uncertainties surrounding future performance. Historically, Tata Motors has been volatile, and this low P/E implies a level of skepticism about the company's ability to sustain recent improvements. Investors must weigh potential gains against these growth concerns. Over the past 5 years, Tata Motors has seen fluctuating growth rates. Sales have grown at a compounded annual rate of 8%, but profit growth has been inconsistent, with sharp variations due to cyclical pressures and market dynamics. For instance, while recent profit numbers have improved significantly, past years saw steep declines. This inconsistent track record is something investors should carefully consider, as it poses risks to future growth sustainability. A more stable performance would reassure investors, but the company still needs to prove it can manage challenges consistently. From a technical standpoint, Tata Motors is trading at 806 rupees, a 32% discount from its 52-week high of 1,179 rupees. The stock is nearing a critical long-term support level at around 600 rupees, which has historically provided strong buying interest. If this support holds, it may present a buying opportunity for long-term investors. However, any breach could lead to further downside. The current downtrend highlights caution, so monitoring price action near support is crucial. Remember, this analysis is for educational purposes only. Always consult a financial advisor before making investment decisions. Aarti Industries Q2 results reveal a challenging quarter. Net profit plunged 42.8% year-on-year to 52 crore rupees, missing Bloomberg's estimate of 77 crore rupees. Revenue fell 12% to 1,628 crore rupees, also below the expected 1,655 crore rupees. EBITDA dropped by 15.5% to 197 crore rupees, versus the forecasted 243 crore rupees, with margins slipping to 12.1% from 16%. This marks a continuation of weaker performance in recent quarters, as the company faces persistent pressure on both revenue and profitability. A combination of demand constraints and cost challenges has weighed heavily on its financials. Aarti Industries, with a market capitalization of 17,211 crore rupees, is a major player in the chemical sector, manufacturing a wide range of organic and inorganic specialty chemicals. The chemical industry, in general, has been under pressure in the last few quarters, with many companies reporting subdued results, barring outliers like solar industries. Aarti Industries has not been immune to these broader sector challenges, facing issues with demand and profitability. However, it holds a strong market position, and any turnaround in the chemical sector could benefit the company in the long run. Aarti Industries currently trades at a P/E ratio of 35.6, which is elevated compared to its historical averages. This indicates that, despite poor earnings performance, investors still expect a potential recovery. However, given the current earnings pressure, the valuation appears stretched. Market sentiment remains cautious, especially with profit margins under significant strain. If profitability continues to lag, the stock may face further valuation compression. Investors should be mindful of this high valuation in relation to the company's recent inconsistent financial performance and sector-wide headwinds. Over the past 5 years, Aarti Industries has demonstrated moderate growth, with sales compounding at around 9% annually. Profit growth has been inconsistent, dropping to a meager 1% in the trailing 12 months. The lack of consistency is a concern, as previous years showed stronger growth. This deceleration reflects both company-specific challenges and broader sector dynamics. Investors should note the slowdown, as sustained profitability remains uncertain. The company needs to stabilize its margins and improve demand trends to return to a reliable growth trajectory. Technically, Aarti Industries is trading at 475 rupees, down significantly from its 52-week high of 770 rupees, reflecting a nearly 38% discount. The stock is hovering near a crucial long-term support level at around 450 rupees, which has historically acted as a strong base. If this support holds, it could offer a potential buying opportunity for long-term investors. However, a break below this level might signal further downside. As always, this analysis is for educational purposes only. Investors should consult with their financial advisors before making any investment decisions.